Good morning, everybody. My name is Ryan Hughes and I'm Head of Active Portfolios here at AJ Bell, and I'm delighted to be bringing you the Q3 2020 update on the AJ Bell Managed Portfolio Service. What we'll be doing today is zipping through in about 20 minutes, half an hour, depending on how much in the flow I get. Depends how excited I get when I talk about what's been going on the last 3 months, but we'll talk a little bit about an introduction to AJ Bell Investments. We're getting new investors and new people interested in our service all of the time. So we'll do a little introduction for those newcomers, so you're very much welcome. We'll review performance, we'll review market performance and MPS performance over the third quarter, and then we'll lift the bonnet and take a little bit of a deeper look at some of the main drivers for that, and also think about some of the changes that have been made over the quarter, and try and bring all of that together into some sense of order as to where we are in markets and where we think we may be headed, albeit if you would probably bear with me, because I reckon that's pretty difficult right now, but we'll give it a go. We'll see how we get on. Right, so first of all, let's just give a quick introduction to AJ Bell Investments for those of you that aren't too familiar with us. We've been going quite a few years now. Actually, our longest investment products, our Pactive MPS, have got over 4 years of history now. So for those of you that think we may be newcomers, we've had some strategies running for quite some time and built up a pretty good track record, as we'll see. The business is growing and going from strength to strength, and we thank you all for your support over the last couple of years. We're now managing over 800 million across our range of products, which is really pleased with that progress, and we really are very grateful to every one of you that's entrusted us with your clients' hard-earned money. We never forget whose money it is, and we'll always have that at the forefront of our thinking with every investment decision and action that we take. Very wide range of investment solutions for you, covering both passive and active. We're agnostic in that debate. We know that you know your clients better than we do, so we have solutions covering both. We also have Pactive, which is the marriage of both passive and active, for those of you that want something in between. We have growth solutions, income solutions. We also have some passive funds, so it's not just about MPS, it's also about the funds, and also a retirement portfolio solution. So lots and lots of things to talk to you about. We're not going to go through them all today. What I talk about in today's update kind of covers what's going on beneath the bonnet in all of these solutions as we run a very common strategic asset allocation and investment implementation approach. So let's just take a quick look at the numbers here. This is the Pactive MPS. We've got what's gone on over the last quarter, and dare I say it's been a little bit more muted over the last quarter compared to the last couple of updates that we've given. But I think what's important here is we look to the more of the right-hand side. So the 12-month number is looking nice and consistent. Obviously, we'd like that number to be higher, given what's going on in markets. That's pretty tricky. But over the 12 months, each one of these strategies, the growth strategies, is second quartile against their respective investment association sector averages, which we are pretty pleased with. These are meant to be core solutions that deliver long-term returns in line with expectations. So delivering a second quartile performance across the board is something that we're pretty pleased with. And actually, when you look on the longer term, when you look over 3 years, then Passive 1 and Passive 2 are actually first quartile over that period, and 3, 4, and 5 are second quartile there. So for those that have a 3-year track record, first or second quartile across the board. And of course, as I mentioned earlier, they've got longer term numbers as well. Let's turn ourselves to the active. So these haven't been going quite so long. They'll actually get their 3-year track record in February next year. But again, over the 12-month period, all of the growth strategies are second quartile against their respective IA sector averages. So again, an outcome that we're pleased with. We should always remember that to be first quartile over the last year probably would have meant taking a significant amount of risk and really having huge exposure to technology, to US equities, and skewing the portfolio in a way that we don't tend to do, we're not comfortable doing. We tend to run a much more diverse and balanced approach, and I'll perhaps comment on that in a little while later on. And then also Pactive Pactive has been going a little bit less as well, so that'll get its 3-year track record again next year. Sorry, 2-year track record. 2-year track record. Forgive me there. But again, nice and steady returns. It's a combination of the two, the passive and the active. So yeah, I think from our perspective, performance in line with expectations is the key message there. So let's take a look at what's gone on over the last quarter. It feels slightly strange to say that the last 3 months felt, let's dare I say it, more normal from an investment markets perspective. But of course, that's in context of the previous 2 quarters, which saw almost unprecedented volatility over that period. So looking across the board here, yes, there was some volatility, but nowhere near to the same degree that we saw in the first half of the year. So that was encouraging. And of course, yes, there were ups and downs in markets as various pieces of news came out around COVID and the virus and what impact that was having, and markets were very sensitive to that, as you can imagine. But on the whole, markets moved higher. And actually, for the first time in a while, it wasn't the US that was leading the charge. I should say all of these numbers are in sterling. It was the emerging markets and Asia leading the charge. And we're up over 4.5% over 3 months. The US, of course, still doing very, very well. And if we broke that down further, we would see the NASDAQ absolutely flying over the last 3 months as well. And when we look further down that chart there, we can see once again, it was perhaps a more normal period for fixed interest with returns a little bit more muted over the quarter. And then we get close to the bottom and we see the FTSE All-Share, that UK market just continuing to lag, a consistent theme for those of you that have tuned into these quarterly updates over the last few quarters, the UK market just struggling in the face of overseas returns. And we'll look at a couple of those headwinds shortly. So looking, kind of unpicking that chart and thinking about what's really been happening. Well, definitely a wide dispersion between asset classes, as we've seen on that previous chart. The best performing market there up 4.5%, and the worst performing asset class down over 3%. So certainly a big spread in returns across different asset classes and different markets over the quarter, and much of that to do with the emergence of the second wave, which, as I record this webinar now, certainly reading the headlines this morning of record numbers of cases in France and in Spain, and record number of cases coming in the UK as well. So these are certainly tough times from a second wave perspective. Emerging markets and Asia led the way, as I mentioned, and if we look beneath the bonnet of that, that was very much led by China. China was a very, very strong performer over the quarter, especially around the internet names. So technology was very much a core theme driving markets over the quarter, and of course those big players in China, your Alibabas, your Tencents, they were the kind of businesses that have been powering ahead, not just over the last quarter, but over a longer period of time as well. But the market turned their attention to those a little bit more away from the US, which of course also did very, very well. Now, perhaps a key event over the quarter was a major shift in US inflation and interest rate policy from the Federal Reserve. Now, it looks relatively minor when you type it out on the slide, moving from an absolute number of 2% to a 2% average. But I think that has much bigger implications over the long term as we think about what that means for interest rate policy from the Federal Reserve there. And essentially what that's saying is the Fed, before, if they'd seen US inflation get to 2%, then they would have been very quick to deal with that on an interest rate basis by raising interest rates to try and keep that inflation under control. What they're saying now is actually they're very, very comfortable allowing inflation to run a little bit hotter than that 2% absolute number and have a longer term 2% average. So although we may be some way away from interest rate rises, given the state of the economy, I think it's fair to say that the Federal Reserve have signaled to the market they are very, very comfortable being behind the curve when it comes to raising rates over the medium term. So lower for longer has been a phrase that's been around for a long time. I think we need to update that now to lower for even longer. and we'll see how that plays out over the next couple of years. Now, as I mentioned, the UK was absolutely the major laggard again. Now, Brexit, we talked about that a lot in the last few years. I'm sure all of you listening will probably say we've talked about it too much as a nation, but we are once again getting to the final act of Brexit, although I fear I may have said that a few times over the last couple of years. But perhaps a slightly different negotiating regime as we stand now, and it feels like that those negotiations are intensifying as they work towards a hard deadline, not a hard Brexit, sorry, a hard deadline around those negotiations. And we know that the EU has got a habit of pulling a deal out of the hat at the very last minute. So we fully expect these negotiations to go right down to the wire. But of course, that's creating uncertainty for the market, for investors, and has meant that the UK equity market certainly remains very much out of favour from both almost a UK investor perspective, but definitely an overseas investor perspective. The other major news was in Japan, where Prime Minister Abe sadly had to stand down for health reasons. Now, he was Japan's longest serving Prime Minister at over 8 years, but has had ongoing health issues for a while and sadly had to stand down. So we've seen a new Prime Minister now appointed in Prime Minister Suga, and apologies for anyone who speaks Japanese with my pronunciation there. But he has certainly made the right kind of noises that he will be looking to continue the reform and agenda and the economic approach that Prime Minister Abe, or former Prime Minister Abe, had taken over the last 8 years. So we will see how that plays out in the coming months. In the fixed interest market, high yield was very strong as equity markets were rallying. Corporates were also in the positive territory, and that's certainly been helped by central banks buying bonds directly in the market now, and effectively employing QE in a different way to support the market. So that's really provided some underpinning to the corporate bond market. So let's look at a couple of issues in detail, as we always do here. A couple of major themes driving the market. Quite often we talk about currency because it often is the purest expression of what investors are thinking, because of essentially being the largest, most liquid market in the world. So currency markets tend to reflect economic and political noise and news faster than any other bit of the market. And it was once again a very volatile period, but actually quite a different picture this time than we had seen previously. So what we can see here, this is sterling versus US dollar, and actually over the quarter, what we can see is that the sterling has strengthened against the dollar by about 4% actually over the period here, which of course creates a headwind for overseas exposure and a tailwind for domestic exposure. As those profits are translated back into sterling for those overseas earners, it makes it a little bit more of a challenge. Now, we know that the FTSE 100 index has roughly about 70 to 75% overseas earnings. So small moves in currency do have a big impact on the profitability of these big companies, these big constituents of the FTSE 100. And as a result, currency moves have a very strong influence on the performance of the FTSE 100 over any period. So a headwind from sterling, no surprise that translated into a headwind for the FTSE 100 index. Now, as we run into the end of the year with Brexit, we can see on this chart that sterling has been very volatile over the last year. If I wound that chart back even further, we will be able to see the key Brexit events that were going on. In fact, right back at the start of that chart, really you can see when Theresa May stood down and there was talk of calling an election, and you can see sterling rallying very strongly from about 122 to 130. I expect we'll get some considerable volatility over the next couple of months with Brexit negotiations as each piece of news comes out. So turning to the US, I thought it would just be interesting to put a chart in of the Tesla share price. This is a share price from launch, giving you the long-term picture. but I thought that when I saw the data, the chart was just truly staggering when we see what has happened essentially over the last quarter. So if we look to the right-hand side of the chart, if we see the sharp spike, the first spike up, and then the big fall, well, that's March this year, so that's the virus, and that's the share price falling to the effective rate of below $100, and then rallying to over $500 at one stage, falling back again since then. But I mean, this is just a remarkable rally in any share price in any company. Now this share price reflects a share split that's actually been done. So the share price, if we were looking a month ago, would have been over $2,000 a share, but they were thinking that optically looked expensive, and so they wanted to bring that price down. Now, in the interest, we of course all believe in efficient markets, I'm sure. So when a company announces that they're doing a share event where they're issuing new shares to lower the price, but no one's holding changes in value, that should have no impact on the price of a share at all, because the market cap of the company is unchanged. Well, Tesla defied those rules and rallied over 10% on that news because people thought it was cheaper, despite the fact that, of course, the company was worth exactly the same amount of money. So strange things happen in markets, even with professional investors here. But this kind of performance, really responsible for driving a lot of the US market return, and of course active managers beneath that. If you were long Tesla, fantastic. If you weren't long Tesla, you were lagging the market. It really was as binary as that. And I think these kinds of growth, we will see if it's sustainable. But clearly, Tesla needs to grow into its earnings, and we shouldn't forget that a lot of profit that Tesla's been generating has been through the sale of carbon credits, not necessarily through the sale of its vehicles. So quite a complex business, but a staggering return profile over the last quarter. So I thought, look, we often talk about China in this, so I thought in these updates, so I thought we'd look at a different market and start turning our attention to India, which has really been in the doldrums for quite some time. As a market, it's been left in China's shadow. Clearly a huge market, over 1 billion people, the world's biggest democracy, an economic sleeping giant, for want of a better word here. And what we're seeing over the last couple of months, and this is the India PMI, so Purchasing Managers Index, so an index effectively of economic activity, and what we are seeing is a recovery to expansion, and that is definitely a positive. We are seeing signs of that play out into the Indian market. Now, it's clearly not as big a part of Asia and emerging markets as the Chinese market is, but it's still a very big and important part of the region, and will, of course, in time grow to be an ever increasing part of global GDP. And so I think it's important to sometimes look away from China, which dominates the headlines, but we are definitely seeing signs of life in India. And yes, they have absolutely struggled with the virus over the summer, as of course just about all nations have. But from an economic perspective, they look like they've turned the corner and are back in the realms of expansion, which is definitely a positive. So that's the economic kind of backdrop that we've been operating in over the last 3 months, and some of the major drivers and events that have been happening. So let's return our attention to actually the underlying MPS themselves. Well, as you saw right back at the start, we've seen steady returns across all portfolios there. The diversification definitely coming to the fore. Some good gains in certain parts of the portfolio. Now, yes, that's absolutely offset by other parts of the portfolios. Now, that is very much in line with how the portfolios are constructed. They are deliberately diverse. We will have positions in sterling bonds. We have positions in dollar-denominated bonds. Now, as you can imagine, with the currency moving like we saw on the previous charts, if you're exposed to the US dollar, then over the last quarter, then those investments would have lost money, but other sterling investments would have made money. And it's about balancing out all of those different risks. As much as when we look in the active portfolios, we've got exposure to growth strategies, we've got exposure to value strategies. over the last quarter, value strategies have struggled, growth strategies have done well, and we're trying to keep the balance right between the two. We won't always get that right in every period, but it's important to understand that we will not be making large tactical moves in these portfolios to try and second guess what will happen in markets in over the short run. That's not what we do. It's not how we manage the strategies. So as we've seen, strong performance was seen in both Asia and emerging markets, with growth definitely being the driver. As we've talked about, the internet and technology and Tesla and the Chinese internet players, all big parts of what's happened over the last 3 months. And I mentioned around the strong sterling holding back the overseas earners in the FTSE 100 continues to be a major theme, and you cannot decouple the currency from the FTSE 100 just given the makeup of the index. And government bonds were weaker over the quarter, a little bit more of a risk on environment, with equities doing well, and government bonds were definitely weaker over that period. So let's look one level below that and think about what actually happened in the active growth strategy, some of the major drivers and detractors. I should say on the previous slide, of course, when we're talking about market drivers, that's effectively what's driving the passive strategy. So we don't go into the underlying individual ETFs and holdings in here, because it's obviously being passive. They're reflective of the market that they're operating in. But we do talk about some of the specific funds and investments that we have on the active side. So a definite highlight was exposure to China. We said China was very strong, and the likes of Invesco Asian, Schroder Asian Alpha Plus, and Fidelity Emerging Markets, which all have big exposure to China. They were significant outperformers of their benchmarks over the period. So Fidelity, for example, has a 10% allocation to Alibaba, which was a very strong performer over the period. So these big allocations to the big major players in China was beneficial. And interestingly, smaller companies was a theme that worked out pretty well over the period. So both in Europe with Barings Europe Select, and in the US with Artemis US smaller companies, both performing strongly in absolute terms. They're both held in the higher risk end of our portfolios, where we look to add a few additional holdings to increase the risk profile there, and that worked out pretty well in those higher risk portfolios. And also what we saw was good, steady, low volatility returns from Janus Henderson UK Absolute Return. Absolute Return funds get a bad press, and dare I say it, quite rightly so. On the most part, there are lots of funds in there that just do not deliver the absolute return profile that they say they will, and we think there are only a handful of funds that are really genuinely credible in this sector, and Janus Henderson is one of those. Now, you'll recall, longer term investors, that this is held in place of physical property on a tactical basis, and physical property, as we know, has been suspended for some period of time, and is likely to be suspended in many of the funds going forwards for a while. And of course, the FCA have announced potential changes to redemption periods, which would ultimately make physical commercial property funds uninvestable for an MPS perspective. And so we've been owning Absolute Return for the last 2.5 years, where we haven't owned physical property at all since we launched the growth portfolios, and that's been the right decision. And Janus Henderson have been delivering nice, steady returns over that period. Now, it wasn't all good. As I mentioned, we build a portfolio in a diversified manner, so we will always have funds that are underperforming and detracting. Now, once again, it was value that was the headwind here. But as I say, we build the portfolio in a diverse mix. We will always have some exposure to value assets here, because we don't know when the market will turn. That's not a game that we're trying to play in making those short-term tactical calls. The market can change and rotate very quickly, and so we want exposure to a wide variety of different investment styles. At some points they will hurt us, and right now value is hurting us, but on the long run we still believe there is merit in buying what managers perceive to be good companies at very low valuations. But of course we need to be patient, and investment is a very patient game. and we're prepared to be patient. Now, if we think those managers are not delivering in the way that we want them to, and we think they should be, then of course we will make a change. But we will not be changing and selling managers just because they are underperforming, when the underperformance is actually in line with how the underlying assets are working. So value is out of favour, our value managers are underperforming, that's in line with our expectations. And yes, it's disappointing, but it comes back to how we build the portfolios. We're more than happy to discuss that in more detail with any advisors, any of you that are concerned about that or want to understand our thinking and our rationale more. So if you are interested in following up on that, then do please get in touch with us. We talked about US Treasuries with the US dollar exposure, so that was weak because of currency moves, and actually emerging market bonds were weaker this quarter after a very strong previous quarter, just kind of showing that rotational nature of what happens in markets. So turning to the income portfolios, well, the income portfolios were a little bit flatter over the period. Income investing continues to be out of favour with investors there, and yeah, that's of course lots to do with still an unclear dividend outlook from a lot of companies. Albeit, when we talk to managers, they are starting to see signs from company management that dividends are very much back on the radar. And so that actually looks quite interesting, I think, for 2021, if some of these companies start playing catch up with their dividend policy. So we'll see how that plays out. Now, of course, that's very much dependent on second waves, on lockdowns, and those types of things. But the right kind of words are being said by company management in respect of their dividend policies. Equity exposure was positive on the whole. But of course, the income style lagged behind broader-based benchmarks, which favoured growth investing, as we talked about. You won't find too many Chinese internet stocks in our income managers' portfolios, as you can imagine, and so there's very much a different styles going on in the market, and income is not one of those that's currently in favour. Fixed interest was challenging, as we've talked about as well, with US dollar bonds and emerging market debt, definitely a headwind for the income portfolios in the short term. And we're having some exposure to property equities, not the physical property equities. So the overseas element of that was hit by sterling strength, which dented those returns, whilst UK property was relatively flat. So what about portfolio activity? Well, just a small bit of activity over the quarter. One change that was made in both the active and the Pactive Growth portfolios there. So very late in the quarter, we made a switch from Fidelity Money Builder Income, which was one of our core active UK investment grade bond funds, into the Artemis Corporate Bond Fund. Now, this is very much to do with conviction in terms of how the manager invests. We still rate the team at Fidelity very, very highly. They run a very strong fixed interest desk, and this is certainly not to the detriment of Fidelity that we're switching out of them. This is much more about thinking about the market environment that we are in. Fidelity is very core and doesn't take too much risk away from the benchmark, and that's absolutely fine. We think in the environment now is if for active management, then they need probably a little bit greater flexibility in their mandate to deliver returns, and they need managers that are very comfortable using that flexibility. And in Artemis, Stephen Snowden is a manager that's comfortable investing away from the benchmark. He's prepared to invest with conviction, and really important, a manager that actually I've invested with over a very long period of time and know very, very well. And what was really important here is that the Artemis Corporate Bond Fund was launched with an OCF of 40 basis points, so very, very different to a lot of other bond funds, and so that's very similar pricing to Fidelity. So ultimately, we were able to get a higher conviction manager for a very similar price to Fidelity, with a strategy that I think suits the market conditions we're going into. So that was a change made right at the end of the quarter. And in the passive growth portfolios, we also saw one change. So the iShares MSCI UK Target Real Estate ETF was switched into iShares Developed Real Estate Index Fund. Now, this the one that has been switched into is a hedged product. So effectively getting improved diversification from a broader-based investment strategy at a lower cost without changing the currency profile. So that switch was made during the period and feels like an intuitively, it's a very sensible one to do. In the income portfolios, there were no changes during this quarter. You'll recall we made one change in the previous quarter in the second income portfolio, where we switched some money out of UK equities and into high yield bonds, and that is a switch that's playing out quite nicely. So high yield has been outperforming UK equities since we made that switch. So let's just try and sum that up and that race through in the last 20 or so minutes. We're certainly seeing economic data that's beginning to show the impact of the global shutdown. Yes, PMIs are looking better, so some of the forward-looking data is looking better, but the unemployment side of things, of course, has got a lag in that. So that is starting to pick up sharply. So things like the furlough scheme that come to an end in the UK now, that means that that unemployment is likely to pick up, and will have certainly knock-on impacts on other parts of economic data. So yeah, that is quite a mixed picture. Now, of course, unemployment is a lagging indicator of what's going on in the economy, but it's still a very important measure that the market looks at. Central banks are buying bonds directly. Now, that is keeping bonds yields low, and the market is effectively becoming artificial in some places. So yeah, hence the switch I talked about on the a couple of slides ago with the switch into Artemis, about making a manager who's prepared to really invest with high conviction to be able to navigate that. Equity valuations absolutely are high in many places, but this is, sorry, not in many places are high, but this is skewed into a narrow set of companies. So there is a very, very wide dispersion in valuation across the market. And that, of course, has been driven a lot by technology, as we've mentioned a couple of times. Now that is leaving some other companies, in the view of some of our managers, as being very, very cheap. But of course, with that comes a need to be very patient, as we talked about with the value style. So that we watch with interest, but it's important not to look at market levels as a whole, but look beneath the market and see actually what's going on, to see how the composition of the market is changing, to see the valuations of the different parts of the market. So that's something we're very interested in as we go into the end of year process, when we look to our long-term asset allocation approach. Now, of course, other issues remain as kind of a finishing point here. Over the next quarter, there are many, many issues to come out that will have huge implications for markets, for society, for all of us in our lives. Of course, Brexit and the outcome of that, and whether we get a deal or we don't get a deal, clearly going to have big implications for UK equities, for currency and UK bond yields. Trade wars and the US election are intertwined. We've got the US election coming up, the battle between Trump and Biden. I'm sure you're all making your own mind up about which way you want that to go, but yeah, it's delicately poised, and it's still, as we understand news coming out of the US, it's all to play for. And of course, very different policies, very different people, and that will have a major impact on the US economy and political situation for the next 4 years, particularly in respect of relations with China, which one side may have a very hostile approach to China, and one may have a more accommodative approach to China. And so therefore that has an implication for trade wars. So all of these things are in their own right. Any one of these would be a massive issue, potentially impacting on markets over the next quarter. But when we think we've got all of them together, then we really do have the potential for some pretty volatile times during the fourth quarter here. Hence the portfolios being diversified, hence the portfolios having exposure directly to dollars, to having exposure to sterling, having exposure to different styles of investment, and being using that diversification to hopefully kind of embed some shock absorbers into the portfolio. We saw that in March with the sell-off, when the portfolios performed better than many others because of that inbuilt diversification, and we hope that stands us in good stead during the fourth quarter. So that's all I wanted to say. Just a quick reminder to keep looking at our website, our newly refreshed website. Actually, it's actually reminded me I need to update my slide with this image here, which is of our old style website. So do take a look at our newly refreshed website. There is lots and lots of information there. Our quarterly reports will be out shortly after this webinar has been recorded there. So lots of information. And as I said, if you want to talk to us about any aspect of what we're doing in our portfolios or our funds, then we would be absolutely delighted to hear you. So it just leaves me to say, I hope you've all been keeping well, your families and your clients have been keeping well. I hope that continues in the future, and we look forward to speaking to you again very soon.